In the past few years, changing interest rates and inflationary conditions have led some fixed income investors to shift strategies to find more stable returns. However, what's worked in the recent past may not work today. For example, in 2022, the return of inflation topping positive yields led some investors to concentrate on high quality fixed income, and in some cases, strictly on US Treasuries. Then in 2024, many investors shifted to short term cash investments as yields hovered around 5%. Just as in the broader portfolio, concentrations in one particular asset class can add risk to a portfolio and lead to greater price volatility than necessary. Here's why we believe diversification is a smarter course, particularly now. In Washington, D.C., prospects for tax cuts and spending changes may bump into the debt limit and require a delicate dance to get through the Republicans' narrow control of the House. Congress needs to pass new spending resolution by March 14th and raise the $31 trillion debt ceiling unless a deadline is extended to allow further negotiations. Ultimately, increasing the nation's dependence on borrowing gives bond markets a stronger voice. In recent years, we saw higher borrowing costs in the United Kingdom, France, and the United States, with budgets centered on more spending and tax breaks. When government borrowing increases, interest rates, or yields, paid to bondholders may rise, increasing government interest costs. However, as in the traditional portfolio blend of stocks and bonds, debt markets themselves are also interconnected and may react in opposite ways. What may be a negative for one segment of fixed income likely benefits other bond segments. Given the range of solutions on the table for shaping the deficit, a well-diversified approach across high-quality bond exposure may help increase fixed income portfolio stability. Toward this end, investors starting to accumulate assets could consider a diversified core bond fund. Investors with larger portfolio balances may choose to spread exposure across treasuries, agencies, mortgage-backed securities, corporates, foreign bonds, and even municipals for an array of strategies. Your Ameriprise financial advisor can recommend an approach designed for your unique financial goals.